There's a market where people believe they can change their lives in a matter of days. A place where numbers move so fast that it feels like opportunity is everywhere. Prices rise. People celebrate. Prices fall. People panic. And in the middle of all this movement, most participants think they understand what's happening, but they don't. Because what looks like opportunity on the surface is actually a system in motion underneath, a system driven by forces that are not immediately visible. And if you don't understand those forces, you are not participating in the system. You are being carried by it. Cryptocurrencies don't move randomly. They move based on flow of money, flow of attention, flow of belief. And these flows behave differently than in traditional markets. They are faster, more sensitive, and far less stable. To understand this properly, imagine the crypto market as a structure made of colored blocks. Each block represents money entering the system. When new money flows in, blocks begin to stack. The structure grows. Prices rise. At first, the movement seems controlled, almost logical. But that perception is misleading because crypto is a system with very low resistance. In traditional markets, it takes a large amount of capital to move prices significantly. There are barriers, institutions, regulations, and deeper liquidity. In crypto, those barriers are much lower. That means smaller flows of money can create much larger movements. And this is where acceleration begins. When the first block starts stacking, the movement is not very noticeable. Only a small group sees it. Early participants, those who are paying attention to flow rather than price, begin to position themselves. At this stage, the structure is still small, but it is forming. Then something happens. The structure becomes visible. Prices begin to rise more clearly. Charts start attracting attention. Social media picks it up. Narratives begin to form. And suddenly, more people become aware of the movement. This is where behavior starts to amplify the system, because people don't enter based on structure, they enter based on movement. They see prices rising and assume it will continue. They feel like they are late. They feel pressure. They feel the need to act quickly. And that emotion creates more money enters. More blocks are added. The structure grows faster. Prices accelerate. And that acceleration attracts even more participants. This creates a feedback loop. Price attracts attention. Attention attracts money. Money pushes price higher. And the cycle repeats. But this cycle is not built on stability. It is built on momentum. And momentum is powerful, but temporary. At my point, the system reaches a phase where everything feels strong. Prices are high. Confidence is everywhere. People are talking about gains. New participants are entering every day. It feels like the system is stable. But it's not, because what's holding the structure up is not solid foundation. It is continuous inflow. The system needs new blocks constantly being added to maintain its height. And the higher it gets, the more pressure it carries. Now, here's where most people make their biggest mistake. They believe that because the structure is high, it is strong. But height is not strength. Height in this system often means fragility. Because the entire structure depends on continued demand. And demand is driven by behavior, not necessity. And behavior changes quickly. At a certain point, inflow begins to slow, not stop. Just slow. And in a system that depends on acceleration, slowing down is enough to create imbalance. Fewer blocks are added. The structure stops growing at the same pace. Prices hesitate, and hesitation introduces something new into the system. Uncertainty. And uncertainty changes behavior. Some participants begin to question the movement. Others decide to secure profits. A few start exiting. And when blocks begin to be removed instead of added, the system shifts direction. This is where the reversal begins. At first, it looks like a normal correction. A small pullback, something temporary, but then behavior amplifies the movement again, this time in the opposite direction, because fear spreads faster than optimism. When people see prices stop rising, they become cautious. When they see prices fall, they become reactive. And when they see others exiting, they feel the need to exit too. This creates another feedback loop. Price drops, fear increases, selling accelerates, and the cycle repeats. But here's the key difference. Downward movements are faster, because when people buy, they hesitate. When people sell, they rush. Liquidity disappears. Buyers step back. Sellers become aggressive, and the structure that once grew rapidly now collapses even faster. Blocks fall. The structure breaks, and what once looked strong reveals itself as unstable. This is why cryptocurrencies don't just fall. They collapse, because the same system that created the rise is now working in reverse. The same forces that pushed the market up are now pulling it down. And most people are caught in the middle of this transition because they didn't enter at the beginning. They entered when the movement was already visible. They entered when the structure was already high. They reacted to price, not to flow. And when the reversal happens, they are not positioned to handle it. They panic, they sell, and they become part of the downward pressure. This cycle is not rare. It repeats constantly because the system itself doesn't change. Only the participants change. At a deeper level, what's happening in crypto is a reflection of a broader financial principle. Money moves toward opportunity. When liquidity is high, capital flows into assets that can move quickly. Crypto becomes one of the primary destinations for that capital. And when liquidity is abundant, the system expands easily. But liquidity does not stay constant. It is influenced by the larger financial system. Interest rates, for example, play a major role. When interest rates are low, money is cheap, borrowing is easier. Risk-taking increases. Investors look for higher returns, and that pushes money into more volatile assets like crypto. This increases inflow. More blocks are added. The structure grows faster. But when interest rates rise, everything changes. Money becomes more expensive. Risk becomes less attractive. Capital begins to leave speculative markets, and crypto reacts immediately because it is one of the most sensitive systems to changes in liquidity. Blocks stop being added, then they start being removed. And once again, the cycle shifts. Another important force driving this system is psychology. People do not act purely based on logic. They act based on perception, emotion, and social influence. They see others making money and assume they should enter. They see prices rising and believe it will continue. They see prices falling and assume it'll collapse further. And these reactions create movement, which then reinforces the system. This is why crypto behaves the way it does. It is not just a financial system. It is a behavioral amplifier. It magnifies optimism. It magnifies fear. It magnifies momentum. And because of that, it produces extreme outcomes. Achisami point, if you observe this long enough, something becomes clear. Crypto is not about predicting the future. It is about understanding the present structure. Where are we in the cycle? Is the structure forming? Is it expanding? Or is it already extended? Is money entering? Or is it leaving? Is behavior driven by curiosity or by urgency? These questions matter more than any prediction because they tell you where you are inside the system. And once you understand that, your perspective changes. You stop chasing movement. You start observing flow. You stop reacting emotionally. You start recognizing patterns. You stop focusing only on price. You start understanding structure. And this is where the real difference appears. Because most participants will continue doing the same thing. They will enter late. They will follow hype. They will react to movement. They will panic during drops, and they will repeat the cycle. But a smaller group will approach it differently. They will understand that fast growth is not stability. They will recognize that rapid rises often lead to rapid falls. They will see that momentum is temporary, and that structure matters more than price. They will not try to control the system. They will try to understand it. And over Chimi, that difference becomes significant. Not because they win every time, but because they avoid the worst parts of the system. They avoid entering when risk is highest. They avoid staying when the structure is breaking. They avoid reacting based on emotion, and instead, they move based on awareness. At the end of the day, cryptocurrencies are one of the clearest examples of how financial systems behave under pressure. They move fast. They react quickly. They amplify everything. And because of that, they expose something that exists in all markets, but is less visible elsewhere. That price is not just value. Price is behavior. Price is flow. Price is reaction. And once you understand that, you stop seeing crypto as unpredictable. You start seeing it as a system. And when you see the system, you stop being controlled by it, and you finally understand where you stand inside it.